Welcome to Frost and Sullivan's Growth Podcast. In each episode, we take a deeper look at transformative shifts shaping global ecosystems, from industry megatrends and technology innovation to evolving customer expectations. Today, we're exploring how the alternative fuels industry is evolving from ambition to execution and what it will take for companies to compete as commercialization accelerates.
Alternative fuels are becoming increasingly important to energy security, industrial decarbonization, and economic resilience. The conversation is no longer centered on whether these fuels will play a role in the future energy mix. Instead, the focus has shifted toward scaling production, securing demand, and building commercially viable business models.
That shift from ambition to execution seems to be creating a very different set of challenges for industry participants.
Exactly. Companies now need to move beyond announcements and pilot projects. Success depends on securing reliable feedstocks, navigating regulatory complexity, building infrastructure, and creating long-term offtake demand. These are operational challenges that require a different mindset than early-stage innovation.
And unlike traditional energy markets, no single company can solve these challenges alone.
That's one of the defining characteristics of this industry. Alternative fuels require collaboration across producers, technology providers, infrastructure operators, investors, regulators, and end users. The organizations that build strong ecosystems will be better positioned to reduce risk and accelerate deployment.
Let's start with one of the less discussed barriers: internal challenges within energy companies themselves.
Many organizations are trying to scale alternative fuel businesses using operating models designed for conventional energy markets. Long approval cycles, rigid investment processes, and siloed decision-making can slow progress in a market where speed and flexibility are becoming critical competitive advantages.
So cultural transformation is becoming just as important as technology investment.
Absolutely. Companies are modernizing investment frameworks, encouraging cross-functional collaboration, and expanding digital capabilities to improve visibility and execution. Organizations like Ørsted, Equinor, and Repsol are already adapting their operating models to better support energy transition initiatives.
Energy security has also become a major driver of alternative fuel adoption.
Recent geopolitical disruptions have highlighted the risks of relying on concentrated energy supply chains. Governments and industrial buyers are increasingly prioritizing energy resilience alongside sustainability. This is creating new opportunities for alternative fuels, particularly in regions with strong domestic resource availability.
What strategies are companies using to strengthen resilience?
The focus is on diversified feedstock portfolios and geographically distributed production networks. Companies such as Neste, Shell, and Saudi Aramco are pursuing multiple pathways to reduce supply risk and improve long-term flexibility in an increasingly uncertain global environment.
Infrastructure remains another major challenge. Production capacity alone isn't enough to drive adoption.
That's right. Storage facilities, transportation networks, fueling infrastructure, and distribution systems all need to scale alongside production. The challenge is that these investments often require significant capital before demand fully materializes, creating considerable first-mover risk.
How are companies addressing that challenge?
We're seeing growing interest in co-investment partnerships and shared infrastructure models. Organizations such as Macquarie Group, Brookfield Renewable, and Vopak are helping create infrastructure ecosystems that distribute risk across multiple stakeholders while accelerating market development.
Another interesting trend is the move toward decentralized production models.
That's being driven largely by feedstock availability. Agricultural waste, renewable electricity, industrial byproducts, and other resources are often distributed across multiple locations. Modular production platforms allow companies to build closer to feedstock sources and reduce transportation costs while improving deployment speed.
And that requires a different approach to operations and investment.
Exactly. Companies are increasingly managing portfolios of distributed assets rather than relying solely on large centralized facilities. Organizations such as Topsoe, Clariant, and NG are developing scalable models that support flexible deployment across multiple regions.
Before we close, let's talk about green fuel corridors, which are attracting significant attention across the industry.
Green fuel corridors address one of the industry's biggest challenges: demand certainty. By connecting fuel production, logistics, infrastructure, and end users within defined routes or regions, these ecosystems create confidence for both suppliers and customers. Companies like AP Moller-Maersk, the Port of Rotterdam Authority, and BASF are helping demonstrate how coordinated ecosystem development can accelerate adoption.
The future of alternative fuels will depend on much more than expanding production capacity. Success will require diversified supply chains, partnership-led infrastructure development, decentralized production models, and stronger alignment between fuel producers and end users. Organizations that connect supply, infrastructure, and demand most effectively will be best positioned to capture growth and establish lasting competitive advantage. Thanks for joining us on Frost & Sullivan's Growth Podcast. For access to our research, competitive benchmarking, and best practice frameworks, head over to frost.com or email hello@frost.com. We'll be back soon with more to help you stay clear-headed and growth-ready.